Hey, everybody, welcome back to another beautiful day in real estate. We have a lot to cover today. I'm actually getting really excited again. I'm not gonna lie, it's been a rough last couple of weeks, but I'm starting to see some light at the end of the tunnel. So let's dive into it. Okay. First off, interest rates, they were peaked at 6.64. We're down to 6.4 on the conventional. However, this is what's really making me excited. FHA is back down on the 5.88 range again. Now, this is, again, an average, so it's going to vary depending on who you're working with. But do you know what this means? This means that there's a lot of first-time home buyers out there. First off, like conventional is not nearly as common as FHA at this point. I think a lot of people just don't have the 10%, 20%, 5% down. 3.5% really just saves a lot of people. But dude, this right here, this is kind of exciting because some lenders are offering buy downs to this one, a full point. Some are offering, builders are offering buy downs as well. Like this can get you into the high fours. And there was a program that was offered here in Bismarck. I don't know if it's still going on, but a friend of mine, she works over at Choice Bank, and she was letting me know about it. There's a couple banks that have it, but basically it was a state-backed loan, and if you made under $102,000, you could get as good as a 4.84 interest rate. That's pretty freaking big. That's pretty big in this market, right? So, you know, I'm going to play devil's advocate here. And a lot of people say the market's terrible. I disagree because I'm going to go look at a property myself. Like I've been dead set on building all year long since last fall. I'm building with my building company, and then a property with 2 acres, 3,000 square feet, 5 bedrooms, 3 bathrooms, an unfinished basement, and a detached garage that looks like it's unfinished. We're going to find out today. $525,000. In my mind, in a good market, that should be close to 7. So we're going to walk through that and see are we going to jump ship and go buy a house rather than build, which is not something I typically am going to think about. But anyway, if we start to continue to see interest rates drop like this, God, this is going to be perfect. Right after Easter weekend, it's going to be really nice, you guys. So moving into the weekend, we have to see how Friday ends. We'll have to see how this goes. There is one thing that the black swan of 2026, we'll call it. There's a good shot that we're going to run into some issues. But right now, the interest rates I'm seeing are really exciting because a lot of people stepped away because interest rates ticked up, but now they're coming back down again, and they're coming down pretty quick too. Like within a week, we saw a 0.5% drop. That's pretty, a quarter basis point. I guess it's not a 0.5%. It's about 0.25%, but that's still a pretty big move. I mean, that's really good to see. I'm excited for that. It means that we're moving in the right direction. But anyways, so first thing, and this kind of correlates with it, but it says, 30-year mortgages rose to the 5th straight week, a 6.4 high since September 2025. In some cases, right? In some cases, but I think a lot of people are starting to see and feel a little bit different. They're starting to see themselves in a more positive note. But what doesn't make sense to me is that oil prices are back up. Okay, so we saw that tick down, and I kind of expected us to hit 92 to 87, and it kind of went right back up. It rebounded, right? With that being said, I would have expected the 10-year bond to move up, but the 10-year bond doesn't look great at all. This is yesterday's candlestick. It closed. We had a push up, and then it went right back down. And I mean, that's a lot of volatility to bring it from all the way up to 4.38 and back and close it down at 4.31. I mean, this is probably, maybe it's going to run again. Maybe we're going to see something, but I mean, typically you can kind of see here, same thing went down, same thing here went down, same thing here went down. I mean, it's right now for me, I think we saw a recent high up here at 4.48. I think we're actually heading south right now. A lot of people are uncertain, and I think I know why. So the reason this might be playing a factor means that more people are buying into the bonds right now. They're trying to figure out what next steps look like. I mean, we had some positive news come out this morning, and the employment numbers came in, and there was an added 178,000 jobs. So the market opened 2 minutes ago. So we'll kind of see the reaction on how that looks. Wall Street will kind of determine a little bit, but this is non-farm payroll, right? So 178,000 jobs added. That's a pretty solid amount. I mean, we were at negative 492,000 before, so the my brain says we shouldn't trust these numbers because how many times have they come out with revised numbers and been like, wow, we were wrong, but here's the actual right ones like a couple weeks later. So I'm not going to lose sleep over it right this moment. It's something good to see, but for the time being, it is what it is. But what we're really going to dive into today is we're going to dive into the credit issues, the private credit concerns, right? This is what I think could be the reason that the market crashes. Everybody says 2008, and I hate how people reference 2008 because we're talking about a different animal here. It I shouldn't say I hate it. It's not real estate that's the issue right now. Real estate, that we're seeing a more buyer-seller gap, more sellers than buyers in a lot of big metropolitan areas. But right now, we're still not to that point, in my opinion. I mean, we still only have like 4 million homes on the MLS. That was as low as it was in 2009, wait, I'm sorry, not low. Am I crazy right now? We were 4 million is pretty low because I think that was down about 40% from a couple of years ago. But not only that, we just haven't seen the cracks in the real estate market. In my opinion, things are correcting. Don't get me wrong. Like things can only go up for so long, and after COVID, there's kind of a reset period. But I think that we're going to see more issues with private equity, more than we're going to actually see with real estate this year. And we're going to dive in on this one. So distressed debt funds, private target credit, private credit downturn as greatest opportunity since 2008. Now, this one caught my eye because it's Financial Times. So I read into it a little bit this morning. They're saying it's the best opportunity since 2008 financial crisis. This is not about a bad few loans, but we're out of the market right now, raising a new fund because this is the greatest opportunity I've seen in my lifetime. I could imagine God would smile on me like this. So what is happening right now is you have BlackRock, you have Blackstone, and you have Blue, just Blue Owl Capital. So what happened is there was a direct increase of people that were pulling money or trying to pull money out of those private equity funds. Those private equity funds are now bought businesses, right? So basically they borrowed investors' money to buy into other investments. And now these people want their money back because, well, they want their money back is what it is, right? It's not too hard to figure out. But what the issue is they said there was a 9.2% in private credit defaults in 2025. However, they're saying that number is probably skewed. And I mean, nowadays, I'm definitely not going to be surprised. But I think what's going to happen is they're trying to convince 401ks and your pensions and things like that to be brought over into these private equity funds and buying up this bad debt so that they can continue to do their thing, right? And pull the equity out, pay investors back. Basically, they're borrowing money so they borrowed money to buy stuff. Now they're borrowing more money to pay off the borrowed money so that they can continue to borrow. I mean, anybody with a fifth grade education can say that doesn't make sense. That means that we're probably moving in the wrong direction. So we can't for the life of us figure out who the losers and winners will be yet. He said it's too early, but since the start of 2025, the firm has invested $3.8 billion, but sold assets worth more than double that amount, far more than usual, suggesting it wants to have cash reserved for distressed opportunities emerge. So what's going on is they're anticipating the 2008 crash is going to be a private equity issue. And that doesn't surprise me. We've been having liquidity issues for a very, very long time. Now, this doesn't mean it's all doom and gloom. There's hope is lost. But we basically have two options. If the private credit is wrong, and I mean 9.2% is a pretty high number, but if we're, let's say 10, 15, 20, 30, it could be at any number. I can't imagine it's 30 yet, but it could turn to that. We're seeing jobs being pulled we're seeing jobs being available. People are losing their jobs because of AI and efficiency, right? People are now trying to pull money out of their investments, their retirements, right? Or their private investments, stuff like that, because liquidity is an issue. People need liquidity. But the problem is we're a debt-based society. So everything is debt-based. So there is no money in the system. So what this means is that when people are trying to pull money out, there's no money to pull out, right? Like all these companies say we have 10 billion under asset, we have 4 billion, we have 3 billion, but how much of it is actually available to withdrawal? Usually very, very low, right? Because just like a bank only needs to keep 1% of the 10 or of the, basically if you put $100 in, that bank only needs to keep $10 in the account on reserve, and the other $90 is being borrowed and, leveraged in the stock market or whatever the case is. This is where people are running into issues because we've borrowed for so long that we don't have any way to kind of revert and go the other direction, right? Tinfoil hat on for a second, right? That's why I believe that we're going to see a shift in financial systems because we need liquidity, right? So there's a couple of things that could happen. First, they could turn on the money printer. There's a lot of talk about the money printer going back on, quantitative easing, big liquidities being pushed into the market. The United States government did their biggest buyback ever. It was $15 billion last week on bad debt. They injected $15 billion into the market quietly. This isn't anything like COVID, but they're just adding money and devaluating the dollar more, right? So now I'm in the conversation of, okay, this is why I struggle, right? Because I could build a house, I could build some equity, I could build cash over here, or I could buy a house on the secondary market that's distressed and I could live there for 4 years, put some love into it, and then sell it for $100,000 profit. Like right now, now's the opportunity for people to get into real estate because there's so few buyers out there, but there's a lot of sellers starting to ramp up that need to sell their homes or want to sell their homes or whatever. My house that I have listed, I mean, we're dropping it below market value. My seller wants it gone and we're not getting any action. We're below market value now, but we're about to drop more than that. She wants to be done with it. But there's not a lot of people that are looking to buy these homes, right? So anyways, well, there we go. So what are they trying to do? What they're trying to do is get banks to pull credit lines. They're trying to create a frenzy of hedge fund managers want to create a sense like the house is on fire, the house is on fire. So they're trying to create chaos so that they can buy. The whole point of this article, and I mean, we jumped through it pretty quickly, but the whole point of this article is there's companies out there that are looking to start buying up the bad debt as they need to, or buying up assets as they need to, because companies are so over leveraged right now that they need to sell some of their assets in order to have capital back in their pockets. So being able to do that, there's companies out there. So there's going to be companies that win during the downward recessions and companies that lose and vice versa, right? So these companies, they haven't really been as aggressive because, this is the Michael Burrys. Those are the ones that are shorting the market. These are the guys that are going to be buying up bad debt. So when the market recovers in however many months, years, they're going to be the ones that are going to sell that money to investment funds that are buying up assets at that time. So you can make money in an upward market. You can make money in a downward market. It just depends on which side of the bench you're sitting on. So these guys in companies like this, they're anticipating that the money is going to take a dump, or the markets are going to take a dump. They're going to buy up the bad debt. Then they're going to ride the wave upwards. So we're going to dive in a little bit here. This is the Blue Owl Capital. So the three major funds that had issues that held, so they had the three major funds, Blackstone, BlackRock, and Blue Owl Capital. They decided that there was a big enough event where people were trying to pull money out, and they capped it. They said, nope, we're only giving out 5%, 10% of that initial request. And that was what pushed those stocks downwards, because basically, to me, that just says there's not money on queue for them to pay those debts, right? BlackRock is the biggest investment fund in the entire world, $10 trillion in assets, something like that, 14 trillion. It was something above 10 trillion. And they don't have the liquidity to pay off a couple $1 billion in a private equity. They need it. And BlackRock is now saying, hey, actually, you guys, let's start investing 401ks and Roth IRAs. Let's start investing this money into here. So we're putting that money into private equity, so then we have some more capital to pay back our. That's where that comes from, right? So they're trying to bring money from over here into the picture, and they're trying to put it in a place that's not safe. That is the black swan that I think we're going to see. If the markets tank, there's a pretty significant, in my opinion, now that we're going to see that. I don't think real estate's going to be the downward fall. I think the stock market is going to be what's going to crash. The stock market's been overvalued for many years. Things like NVIDIA, things like, Apple, things like, I don't even know, Tesla. All of these companies have been overvalued for some time. And it's just the way, the motion of the ocean, if you will, right? When people are, I met with somebody a few months ago. They wanted to sell their condos so that they could invest their money into NVIDIA. They wanted to take the equity out of their their physical asset and put it into a paper asset. when people get to that point, like we've already seen that stock run and run aggressively, right? So there's nothing goes up forever, and the problem is we get locked in and we see green, right? So why wouldn't we gamble? We typically lose all of our money, right? Because I won. I'm just going to keep winning, and then you're going to bet all your money, and you're going to lose on a hand, and then all of a sudden you're down. You're down the money you invested, or you put down. I shouldn't say invested, but you're down the money that you put in, and now you're screwed, right? That's what people are doing in the stock market right now, and that's what COVID created. COVID created a ton of people at home who thought they were day traders and decided to just push money into the stock market, and it worked, right? Because there was so much liquidity coming from the government, stimulus checks, unemployment, things like that, where people were making more money sitting at home than they would have been going to work. And they just wanted to invest it, right? And that's how that market got overvalued. I think the stock market got up to $84 trillion worth of investments. But I'm going to touch on Blue Owl Capital, and then after we're done with that, I'm going to explain what I think is going to shift because of this. Okay, so Blue Owl Capital, one of the most prominent names in private credit, has seen its stock implode under $8, and as investors rush for the exit faster than the fund can pay them out. So again, they're people are trying to pull money, and they don't have the money on hand, so they're trying to get the money to pay people off. So the firm was hit with $5.4 billion of redemptions requests in the first quarter alone. Withdrawal requests at the tech lending fund reached 40% of the fund's $3 billion valuation. The request exit marquee $20 billion direct funding surged to 21.9 of fund value. So about 20% of the $20 billion funds, right? Blue Owl has limited redemptions. Excuse me, I don't know why that stopped for so bad, but Blue Owl has limited redemptions for both vehicles at 5%, effectively keeping investors' capital locked in. So what they're saying is they're saying you can only pull out 5% when they had requests for 21% and 40%. So that's a significant amount of money that's locked up, and they're isolating it, right? The contagion is spreading across private credit broadly, with firms including BlackRock, Morgan Stanley, and Cliffwater all capping fund withdrawals in recent weeks. I didn't realize Morgan Stanley and Cliffwater were in there yet. The U.S. private defaults have reached a record 9.2%. Again, that number could be skewed. More than double the 4.5 default rate in broadly syndicated loan market, right? So when the tide goes out, you'll find out who's swimming naked and the structures that were sold as permanent capital and are revealing themselves as anything but. What this means in a whole lot of words, these companies don't have money to pay out for the requests. So they're finding new ways to borrow money, and by borrowing money, they're going to be able to pull it from different funds. Now, here's what I think we're going to see. And this is my 2 cents, take it with whatever it's worth. But I think people are going to see... I think we're going to see a shift in financial systems where we need to add liquidity to the market, which could be one of 2 ways. A, they turn on the money printer, and I kind of talked about that. Or B, they're going to upgrade the system. Upgrade the system as a whole, and they're going to actually put things on blockchain. I just don't see a way where they're not going to create a system. They are working on it. They're creating it now. It's going through the Clarity right now. It's going through all of these things. I just don't see a way where they're not going to put assets on chain where liquidity is no longer a requirement in order to keep moving forward. It's going to create more liquidity, and funds are going to move more fluent. That's what I'm anticipating. I think we're going to see things shift, and money needs to move. It's going to need to flow. And I think that's where this Clarity Act really needs to come into play, and that's why they're pushing it so hard. They need to create some clarity so that DeFi and decentralized finance is what DeFi is. Decentralized finance and money and banks and all this can move on chain so that they can remove the liquidity that's tied up, because big banks need to have liquidity on tap to receive big wire funds, right? So if you're sending $1 million from one bank to another, that bank needs to have $1 million on their books in order to receive $1 million, right? By putting it on blockchain, by putting it on blockchain, you can send something and have a settled transaction in under 2 minutes, and that money goes from point A to point B. There's no intermediary other than the actual currency. It could be XRP, it just could be a stable coins transaction, whatever it is. But that money is now already settled and in that bank account 2 minutes later. It takes days. It's clunky now. They use the old system and they have to upgrade it, just like everything else. Amazon was an upgrade from shopping at the mall, right? Things like phones, right? The internet was the upgrade for us to continue. iPhones turned into the upgrade so that we had instant data at any point, at any time. They have to upgrade the system. They're going to. That's my 2 cents on this. The private credit issue could be the next black swan event. And if it's the next black swan event, how is it going to recover? It's going to recover by putting things on blockchain so that money can roll or move freely without barriers. And that Clarity Act is going to be a big portion of how that happens. So private credit is probably going to be the issue that we're going to see this year. But as we move into midterms, it looks like nobody's happy with either side. So it's going to be an interesting year. So make sure to like and follow for the summer. We're going to keep you updated into the spring on the real estate market, what to anticipate. And if you have any questions or if you felt like I didn't dive into something great, make sure to comment below. Have a great day.